Each month, I run a stock screener to find the 10 best high-yield dividend stocks for me to consider in the upcoming month. The screening process is focused on finding quality businesses, figuring out if they are attractively valued, and selecting the best ideas based on future return potential. It is an automated process, and as such, it is not perfect. But I've been running this screener for 57 months now, and it has a compounded annual growth rate of 15.24%, which in my opinion is pretty good for a dividend-focused watch list. I share this list along with my top 15 high-growth dividend stock list with my free Patreon and Substack members. So if you find this list valuable, you can sign up for my Patreon or Substack to receive next month's top dividend stock list straight to your email. There are other perks for paid members as well, but there is no pressure to be a paid member. There's plenty of free content I share every month that you may find valuable. Alright, let's talk about the top 10 stocks for August 1st. Then I'll explain the screening and selection process, and wrap up with a summary of the long-term results. The 10 chosen stocks have a forward dividend yield of 3.51%, nearly 3 times higher than the S&P 500. They are potentially 19% undervalued based on dividend yield theory. They have grown their dividends at a rate of 7.53% per year over the last 5 years. And the overall future return potential for these 10 stocks is 15.58%, so right in line with the long-term watchlist track record. And the chosen stocks are Merck, NextEra Energy, Pepsi, Paychex, Essential Utilities, Comcast, PNC Financial, State Street, Restaurant Brands, and Xcel Energy. So we have 3 utilities, 2 financial stocks, a healthcare stock, a consumer staples and consumer discretionary stock, and an industrial stock. A nice mix across various sectors. Let's dive a little deeper into each company, and bear in mind that the data is shown as of July 31st. The first stock on the list is Merck, that has a forward dividend yield of 3.96%, and it appears to be about 25% undervalued. It has a pretty low payout ratio, just under 37%, a decent 5-year dividend growth rate of 6.66%, and a good track record of revenue and earnings growth over the last 5 years. It is also expected to return nearly 20% per year over the next 3 to 5 years. The second stock on the list is NextEra Energy, with a forward yield of 3.19% and a potential 30% undervaluation. It has a reasonable payout ratio, around 75%, and a very strong 5-year dividend growth rate of 10.5%. Revenue and earnings have also grown nicely during the last 5 years, and the return potential stands at 16.87%. Pepsi is the third stock, with a forward dividend yield of 3.98% and a potential 29% undervaluation. Its payout ratio has crept up a little bit and is very close to 100%. The 5-year dividend growth rate is pretty strong at 7.04%, and long-term revenue and earnings have grown at about 6% per year. The future return potential for Pepsi is 12.51%. Stock number 4 is Paychex, with a forward dividend yield of 2.96% and a potential about 10% undervaluation. The payout ratio is decent at about 87%, and the 5-year dividend growth rate is pretty strong, just over 10%. Revenue and earnings have grown nicely during the last 5 years, at about 6 and 8% respectively. And the future return potential for Paychex stands at 13.05%. Rounding out the top 5 is Essential Utilities, with a forward dividend yield of 3.71% and a potential 32% undervaluation. The payout ratio is very nice at 43%. The 5-year dividend growth rate is very respectable at 6.89%. Revenue and earnings have grown very nicely at double-digit rates during the last 5 years, and the forward return potential stands at 16.2%. Stock number 6 is Comcast, with a forward dividend yield of 4.06% and a 39% potential undervaluation. It has a very nice and low payout ratio at 31%, a very respectable 5-year dividend growth rate of 8.1%. Revenue has not grown very nicely during the last 5 years, but it's still a positive 2.5%. Earnings have grown a little bit better, closer to 8%. And the forward return potential for Comcast is 16.13%. Dividend stock number 7 is PNC Financial, with a 3.53% forward dividend yield and a potential 8.7% undervaluation. It has a very nice payout ratio at just 33%, a solid 5-year dividend growth rate of 8.45%, and a very good revenue and earnings growth history. The future return potential for PNC is 17.5%. Dividend stock number 8 is State Street with a forward dividend yield of 2.97% and a potential 4% undervaluation. The payout ratio is very nice, the lowest on the list today at just 25%. The 5-year dividend growth rate is respectable, just shy of 8%. Revenue has grown very nicely at 24% per year during the last 5 years, and earnings have grown at a more modest 8.85%. The future return potential for State Street is 15.41%. Dividend stock number 9 is Restaurant Brands with a forward dividend yield of 3.61% and a potential 13% undervaluation. The payout ratio is a little bit higher, but very reasonable at 80%. It has the lowest 5-year dividend growth rate on the watchlist today, standing at just 3.01%. But revenue and earnings have grown very nicely at 8.45% and 6.08% respectively. And the future return potential for Restaurant Brands stands at 15.96%. And the 10th and final stock on our list is Xcel Energy with a forward dividend yield of 3.15% and a potential 3% undervaluation. The payout ratio is pretty good at just 65%. The 5-year dividend growth rate is respectable at 6.5%. And revenue and earnings have grown modestly at 3 and 5% respectively. The future return potential for Xcel is 12.27%. So these are the 10 high-yield dividend stocks I'm going to consider during the month of August. Let me now spend a moment talking about the screening process. It all starts with the stock screener from Charles Schwab that I use through my brokerage account. The objective of the screening process is to find potentially high-quality businesses that also pay dividends and have a pretty good track record. So I apply the following filters in the stock screener. I screen for a minimum dividend yield of 2.75%. The stock must trade on the New York Stock Exchange or the Nasdaq. It must have a payout ratio of less than 100%. The 5-year dividend growth rate must be positive. I look for a market cap of at least $10 billion. A wide or narrow economic moat rating from Morningstar. A standard or exemplary stewardship rating also from Morningstar. A B or better S&P quality rating. And I also look for a positive 5-year revenue growth rate and 5-year earnings per share growth rate. When I run this stock screener each month, it produces a list of about 30 to 40 stocks that I export into an Excel workbook. Within the workbook, I rank these stocks based on business quality and valuation, and then I combine these rankings to find the best combination of quality and value. The final step in the process is to calculate an expected rate of return for each stock, and I use the following formula to come up with my return estimates. I take the projected earnings growth rate for the next 5 years from FinViz, and I combine it with the return to fair value factor based on dividend yield theory and the forward dividend yield. The return to fair value factor takes the potential over or under valuation and annualizes it over 5 years. So my return estimate is a 5-year return estimate, where I expect the stock to return to fair value, pay me the forward dividend yield it offers today, and hit its earnings growth projections. To select the top 10 stocks each month, I sort the workbook based on the quality and valuation ranking, and I look for the 10 highest stocks that have a return estimate of at least 12%. So as you can see, in the case for August, EOG was the highest ranked stock, but it failed to meet my 12% return estimate target. I also skipped over Hershey and a handful of other companies to make my selections. Alright, so let's take a look at the long-term performance. As I mentioned before, the top 10 list has a CAGR of 15.24% over the 57 months that I've been running it. To give you a little perspective, we can compare it to some benchmarks. The S&P 500 over the same time period has returned 16.49%, so a little bit better than the watchlist. And VYM, Vanguard's high dividend ETF, has a CAGR of 15.06%. So my stock screening process has done a little bit better than VYM and modestly trails the S&P. However, it offers a starting dividend yield nearly twice as high as VYM and 3 times as high as the S&P 500. Sticking with long-term performance, here are the 5 best stocks this watchlist has identified. In first place, we have Broadcom with a return of over 600% since it first appeared on the watchlist. In second place, we have JP Morgan with a return of 242%. In a close third place, we have Bank of New York Mellon with a return of 236%. Number 4 is Progressive with a return of 191%. And number 5 is General Dynamics with a return of 162%. The common trend here is that a lot of these stocks have been on the watchlist for a very long time. So another measure of success I track is the average monthly return since first joining the watchlist. And in this category, Broadcom is still the best, with an average monthly return of 3.91% over the 51 months that it's been on the watchlist. In number 2, we have Goldman Sachs with an average monthly return of 3.32%. Number 3 is Corning with an average return of 2.41%. Number 4 is CRH plc with an average return of 2.3%. And rounding up to top 5 is Fastnell with an average return of 2.24%. In total, there have been 91 stocks that have appeared on this watchlist, inclusive of Discover Financial and Pioneer, that have since been acquired. Out of these 91 stocks, 77 have a positive total return since first appearing on the list, and the average return for these 77 stocks is 71.28%. Now, this leaves us with 14 losers that have negative total returns, and the average loss for these 14 stocks is 27.07%. Another way to measure the effectiveness of the strategy is by running a dollar cost averaging buy and hold test. In this test, I simulate the investment return of dollar cost averaging an equal sum of money into each of the chosen stocks every month, if it is part of the top 10 list. These positions are then left alone and held forever. So, out of the 91 stocks on this list, 74 would have led to a positive overall return in this test. That's an 81.32% rate of success. And I also tested the stocks that appeared on the watchlist more frequently. So if a buy and hold strategy, as I just described, had been applied, more capital would have been allocated to these stocks relative to the stocks that appeared on the watchlist less frequently. In total, there were 31 stocks that appeared on the list at least 10 times, and 25 of them would have led to a positive return, which is an 80.65% rate of success. I've already shown you the top 5 best performing stocks on this watchlist, but there's a handful more that have total returns above 100%, like Philip Morris at 144%, Canadian Imperial Bank at 138%, Principal Financial Group at 135%, Goldman Sachs at 133%, Bank of Montreal at 126%, State Street at 120%, Cisco at 118%, Royal Bank of Canada at 115%, M&T Bank at 112%, Discover Financial before its acquisition at 109%, and Toronto Dominion Bank at 103%. Then we have Corning that is very close to 100% return, Southern Company sitting at 97%, Cummins at 95%, Huntington Bankshares at 95%, Fastnell at 94%, BlackRock at 92%, and Northern Trust at 92%. But of course, we also have a couple of misses, like Intel that is down nearly 50%, Paramount Global that is down over 50%, and Advanced Auto Parts, the worst stock on this watchlist that is down 71%. Like I mentioned before, this process isn't perfect, but it's worked out pretty good for me. The goal is to identify potentially high-quality businesses, catch them when they're attractively valued, and focus only on the companies that present a strong potential return. If you enjoy the content, please leave a like and subscribe to the channel. And don't forget to check out my Patreon and newsletter that are linked below. Thank you for joining me today, and see you next time.